ledger, Hammond length, okay? You just look at it. 2010 includes the following selected accounts. This is from the, before adjusting, okay? So, before adjusting. You look at the debit, you look at the credit, these are some of it. And you have prepaid insurance, office supplies, office equipment, accumulated depreciation for the office equipment, okay? Office equipment will be projector, monitor, computer, unearned revenue. And then we have insurance expires at the rate of 100 per month, okay? So we need to make, we need to make a debit and we need to make a credit, okay? And they give you here on the next page something like a solution, okay? Now solution comes at the bottom here. So for insurance expires at the rate of 100 per month, you have, everyone, hello, I'm trying to give you an example here, okay? I will finish after 10-15 minutes. You have insurance expense 100, and then you have prepaid insurance 100. So insurance expires at the rate of 100 per month. Yeah. When it expires, at the end of the month, you say insurance expense 100, prepaid insurance 100. Now, they may say, and that's a trick, insurance expires at the end of the month, but they say record it every 3 months. So if it's recorded or adjusted quarterly, the adjustment will be insurance expense 300, and here it's going to be 300. Number 2, supplies on hand are 800. So now we need to ask, okay, if now we have 800, how much we had before, and before supplies were 2,800. So before 2008, after 800. The difference is we use during the month 2,000. So the supplies is an asset account, so it's going to be supply debit, supply expense, credit supply. Okay, so debit, office supplies expense, credit, office supplies. 2,000, 2,000. That's it. Next one. Number 3. Office equipment depreciates 200 a month. So, debit, depreciation expense, 200. And on the other side, debit, depreciation, 200. Credit, accumulated depreciation office equipment, 200. All right? And last one. 1/2 of the unearned revenue was earned in March. So, whatever was unearned, 1/2 you recognize. So, we go back to the balance. Unearned revenue, 9,200. So half of it is 4,600. So you recognize revenue. So it's going to become unearned revenue as a liability, right? So we're going to say debit unearned revenue, and then we're going to have credit revenue. Let's see what they say. Debit unearned revenue, 4,600. Credit revenue, you like to say service revenue. Okay? And that's the example. And that's the risk. Now we have one more, I think, final example over here. What I'm trying to get over here is the final. Okay. Alright, that's another one. What's the excitement, guys? I'm trying to give you one more example. We got about 5-10 more minutes. Another example. Calvin and Hobbes, okay, are the owners of microcomputer services. At the end of their first month or whatever, you're trying to prepare monthly statements. Alright, everyone. And they have the following information. Okay. On August 31, they owed employees 800 in salaries that the company will pay on September 1. So you owe the salaries becomes salaries payable, okay? So salaries payable is a liability. And if it's a liability, this means that we'll have to credit the liability. Well, what's the debit? No cash. They don't pay it yet. They owe it. They will pay later. It's a salary, so it becomes salary expense. So it becomes debit salary expense, 800, credit salary payable, 800. And that's it. When they pay, you're going to have debit salary payable, credit cash. Okay? So now we're looking at the first one. And that's it. Debit, salaries expense. Credit, salaries payable. You recognize the expense today and promise to pay tomorrow, later, the salary later. So that's number one. Number two, they borrowed 30,000 from a local bank, okay? On a 15-year note. And the annual interest rate is 10,000. So now we need to do some calculations here. So first of all, you say 30,000 is, well, first of all, we need to calculate the interest, okay? When they borrowed, okay, first of all, let's say we have two transactions. One, when they borrow. When they borrow, you're going to have debit cash, okay? And then credit is going to be note, 15-year note. So it's going to be note payable. That's when they borrow. At the end of the month, you have interest. And the question is, how much is the interest? Okay. Interest is 10% out of 30,000 for 1 full year. So interest is 10 out of 30 is $3,000 is the annual interest. Annual. So for 1 year you pay 3,000. Well, now, if for 1 year you pay 3,000, how much is interest for 1 month? For 1 month. Well, you divide 3,000 by 12, and it's got to be iPads, Google, 250. We call it brains. Use your brains. 250. Okay. So, for 1 year, 3,000. For 1 month, 250. And now the question is, what's the debit? What's the credit? And the debit is interest expense. And credit is, what's the credit for the note? What's going to be interest payable. Interest payable. If it's a salary, salary payable. If it's rent, rent payable. Okay, so whatever it is, you say whatever payable. In this case, it's interest payable. Let's see how lucky I am. Oh, lucky. Interest expense, 250, and then credit interest payable, 250. The calculation is 30,000 is the full note, 10% is the annual note, so it becomes 3,000 per year, and then you divide by 12 to get the monthly, 250. Okay? So that's it. Number two. Number three, service revenue, unrecorded. In other words, they earned it, but did not collect it. They're going to get it later. Okay? So, you're going to have something which is like receivable. Okay? So, you're going to have debit receivable and credit service revenue. So, you say debit some receivable, account receivable, credit service revenue, 1,100. Let's see what they said. Oh, that's it. Debit, Account receivable, 1,100. Credit, service revenue, 1,100. All right, and that's all the rest of it. So this one is fairly simple and fairly easy. You also have and do, let's see, I think summary. Okay. So now you see a summary. A summary simply gives you, okay, this is the advertising expense, this is the supply expense. So they just give you debit, credit, debit, credit, debit, credit. They give you the reference number of where, meaning which account you post to, okay? They just give you all the journal entries, okay? So these are the entries for the adjustments at the end of the month. They call end of month, or better, end of period adjustments. Could be end of quarter adjustments, end of year adjustments. So we say end of period adjustments, and these are the different adjustments. You see the insurance expense, depreciation expense, unearned revenue, accounts receivable, interest expense, salaries expense. And now you transfer these to the ledger. And you have for interest payable, you have an adjustment entry or adjusting entry, 50/50. All right. You see them with red. Accounts receivable, adjusting entry, 200. You got advertising supplies, 15/50. So you just see how we call these post them from the journal to the ledger. You see all of the adjustments. This is for the whole chapter. You can actually read through to see just an example. And then we get to what I was trying to tell you about the adjusted trial balance. So let's see what adjusted trial balance looks like. Okay. Adjusted trial balance is very simple. You take the number after the adjustments. So you have a number before sometimes they make it in 3 columns. I'll see if they have it over here. Before adjustment, which is called unadjusted. Then you have adjustments, and then you have adjusted. In this case, you got the numbers after the adjustments, and you just call it adjusted trial balance. The one which I had in mind is on page 108. And if you open 108, you will see you have 2 columns, debit and credit, okay? Then you have adjustments, debit and credit, then you have adjusted trial balance. Let's see if you can get this little nice table. Can you get the nice table there? Is the table coming up nice? Does it see? Left, right? You can adjust the camera. Yeah? Is it working? Having fun? Can you see well? So you got 3 columns, the unadjusted, the adjustments, and the adjusted. All right, now we can get back to normal. So you have now the adjusted trial balance, and what you have to do is from the adjusted trial balance, you do the same thing. You do the balance sheet by taking the asset, liability, and equity accounts. And then you do the income statement by doing the revenue and the expense accounts. Let's see if they have them over here. Okay. Yeah, this is very nice. Preparing financial statements. This is very nice because it looks beautiful. You see now, you got all of these. Cash, balance sheet, okay? Balance sheet, balance sheet, balance sheet, balance sheet, balance sheet, balance sheet. All of this is balance sheet, okay? This one, capital and drawing, is affecting the, actually the equity. And now you see the red ones, service revenue, income statement, income statement, income statement, expense, income statement, expense, income statement, expense, 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 expense. So all of these revenues and expenses, which are in red color, you see how you copy them, and you copy separately the revenue and you copy separately the expenses. And what I was explaining last time for all of you who were missing and didn't come because it was raining, how you get here the expenses on the left. You got total service revenue on the right, and then you have total expenses on the right. You put in here one line, okay? And on the right, you have the total revenue, you have the total expense. You put in one line, you can zoom in, maybe you can move the camera and zoom in a little bit more, right? And then when you have the, it's called net income, you have two lines, okay? So, if I'm grading your quiz or your midterm, and of course final, I'll be looking for the income statement to see the two lines and get the number and see, did you get the number right? And if not, I want to see, did you get this number right? Or this number right, okay? And see what you got. If everything's right, then it's right. If it's wrong, you got to see what you got wrong. And say, oh, this one's wrong. Now I got to get back to here and say, oh. You see? So you got to trace back things to see where you made, oh, this one, I got to go back to the ledger and then maybe see, okay, this is what the mistake was. You're going to see how many mistakes you made along the way. So, you get the revenue and the expense accounts, you take them and just copy paste, and the expenses keep here a little on the left, and then on the right you get the total expense, you got the total revenue, and then that's it. Now, here, the blue ones, you see the blue ones, capital drawing, you get the equity statement. You have the capital from the previous balance sheet. Well, there was no balance sheet, so it's actually zero. You got the current investments, and you can pull in the capital is in investments, okay? And you get the capital in here, okay? So, original balance 0, additions 10,000, capital is 10,000. And then you have to add the net income. And then you have to subtract the drawings, okay? So, the capital becomes, let's repeat, the original, the old balance, plus new investments, minus drawings, plus the current net income, or if it's loss, minus the net loss. But usually this is the order. You're going to see one line, another line, one line, another line. And then, again, this is all what you're going to need for tomorrow, or, Thursday for the quiz. This is how you do it, everyone. This is how you do it on the quiz without the adjustments, okay? So the quiz is going to be without the adjustments. Quiz 2. The midterm is going to be without the adjustments. And quiz number 3 will have the adjustments for you, okay? Which is coming after. Quiz number 3 after 1 month, after 3 weeks. And then you have the balance sheet. And now you have the balance sheet. It's the same thing. Asset accounts, liability accounts, and the equity coming from the equity statement. You gotta copy, and you gotta basically copy and paste, right? You see how it's done. You have the asset accounts first. They will have a debit balances. That's if it's an asset with a debit balance, it's an asset account. If it's a liability balance, it's of course a liability. And the equity you get from the equity statement. And I think this is for today. Okay, it's just an example. Everybody has you have the PDF file. This is the whole do-it example of, these are the trial balance for the debits and the non-trial balance for the credits, okay? And you have to make some, whatever the adjustments are, and you got a simple solution, okay? And you'll just go through it at home, okay? So, tomorrow, or next time, quiz. After that, midterm. After that, exercises, homework 3. And then we have on Thursday, July 25, we have this, and Next quiz is going to be July 31, right? July 25 and 7 is going to be actually August 1. All right, good enough? Finish?